Hey everyone, we are here with Cynthia from Matrixport, and she'll be doing a talk on how BTC miners can make use of derivatives for risk management. So I'll let her take it from here.
Hi, thanks, Shinju, and hi everyone. I'm Cynthia Wu. I'm heading the business development and sales at Matrixport. Thanks, Dystopia Labs, for reaching out, and congratulations to the success of this online event so far. Seems to be really a big crowd online these few days. And I'm really glad to be here to talk about the risk management using derivative products for miners. For those who doesn't know Matrixport, I would like to give a brief introduction. So Matrixport is a spin-off from Bitmain, the mining giant, last February. So been running as an independent entity for 14 months. And Matrixport provides one-stop crypto financial services for trading, custody, investments, and also loan products. At Matrixport, we believe in the potential of the cryptocurrency, and we believe the audience it will reach out to eventually.
Cynthia,
Yeah.
would you mind making your audio a little louder? The audience is saying they can hear you, but it's not amazing.
Okay. Is that better?
Yes.
Oh, great. It's maximized.
Can you guys hear her? Cynthia, can you continue talking?
Sure. So at Matrixport, we believe in the potential of cryptocurrency, and also the audience it will eventually reach out to. Whether to hold some cryptocurrency is almost like whether you want the financial autonomy of yourself, right? I think the answer should be yes for most of the people, if not everyone. So we made our mantra really simple: make crypto easy for everyone. And the company, as a spin-off from Bitmain, is co-founded by the two out of the three Bitmain co-founders, Jihan and Zhong. I think most of the people in the industry already know them, and they have been making waves in the cryptocurrency market since 2010, and have been with this market over several cycles. And now they're bringing their experiences and insights of this market, and now providing financial services to our user base that's much bigger than mining. And luckily, we have got some really profound investors from the East and West investing into Matrixport. That include Bitmain, IDG, and Lightspeed, and a couple others. After a year of development, we are 150 people globally across 7 offices, and most of people are from 4 different type of backgrounds. The first type of background is financial services, first-tier investment banks and exchanges, and then also traditional tech and internet giants, and also blockchain tech companies, and also compliance, financial compliance background. Yeah, a little bit about myself before I start today's topic. I started to get interested in crypto in 2017, and I joined crypto full-time with Bitmain in 2018. As investment director. And later on, when Matrixport spun off from Bitmain last year, I was responsible for Bitmain's Matrixport institutional custody business. That's called Calculus Custody. And now I'm also in charge of the overall BD and the sales. Yeah. And in my previous career, I was working as a product development specialist at Hong Kong Exchange on the derivative side, market side, and also I was a physical commodity trader. And in my previous career, most of the time I deal a lot with commodity miners as well as trading companies. And I find that there's a lot of similarities between the traditional commodities and Bitcoin mining because they're all like a type of commodities. And they share some very common cost metrics. For example, you have a fixed cost of buying the mining rigs. You also have variable cost of electricity as well as hosting services and manpower. And for the mining to be in profit in the long term, you need to be able to make a profit in your mining operation. And but there's 2 variables which no one can really predict. One is the BTC price, and the other is the difficulty levels. So that's where the risk management really become necessary along the way as there is volatilities and fluctuations in the market. In our product suites, we really offer trading, custody and lending and risk management, and also asset management to institutional and retail users. Given the background of Matrixport and our connection with the mining industry, we have a fairly good understanding of the miners' needs and risk appetite. For example, some miners, they might want to lock in their future price so that they will make sure that they don't sell below their cost of production. Some of the miners, they are very, care about the cash flows, and they want to generate steady cash flows along the way so that that will provide some limited protection when the market fluctuates. So those are very typical needs. And another typical needs is making loans, right? Because most of miners are not really serviced by the banks at today's market. So when they want to really make a big investment into the mining rigs, or they want to build mining farms to expand their operations, or if they want to simply pay electricity bills, some of them, they will need the working capital financing. So that's another type of product we need. Of course, when people borrow money, they care a lot about interest rates. So there are also various different solutions we have for them. Some are really bringing the interest to really low or zero level. Yeah, this chart is, as you can see on the left, it's a spot trading volume. And on the right, it's a futures trading volume. As you can see that this is the data, I think the average daily volume in 2019 on average. As you can see that on the left, the average trading volume is like 3.2 billion, right, for the spot. And on the right is about 7 billion for the futures, mainly futures and perpetual swaps. As an underlying gets more mature, like the most mature commodity is probably gold and crude oil, right? The derivative market of that underlying will grow really fast, and the futures to spot market ratio will reach to about 50 to 100 times for crude and oil. But for Bitcoin, we're still in the early stage, but we already observe a very fast growing pace of the derivative markets. It's probably now 2 to 2.5 times the size of futures market versus options market versus spot markets. And I think in the next few years, the derivative market will still enjoy a very fast speed of growth. There are two factors that's really driving the derivative market growing. The first one is easy to understand, is speculation, right? When the underlying assets get more interesting, and there will be people paying attention to the volatility of this market, they want to participate by making speculations. That will help with volume. And the other factor that's really contributing to derivative market growth is risk management. Similar patterns we have observed in the crypto options market. Right, options market traditionally normally grows on the base of a more liquid futures markets. That's exactly the same pattern here in crypto. As the option market was really, really tiny 2 years ago, only 3 to 4 million notionals every day. That's really insignificant. But we have seen 8 to 10 times year-on-year growth for the past year, and we have confidence that this market is really going to grow at this pace again this year, if not faster. If we reference the ratio of the fiat currency pairs in the traditional capital market, taking the US dollar CNH trading pair, for example, or the US euro, US dollar trading pairs, for example, you can see that the option versus spot plus spot plus futures volume, the ratio should be at 10 to 15%, which means the futures plus spot versus option should be 7 to 10 times. But now it's still very, very small. Using that ratio and benchmark it back to crypto, the Bitcoin option market, we would have some confidence that it will reach, the options market will reach 2 to 3 billion US dollar notionals on every day on daily trading volume in the fairly near future. I think that probably take only 2 or maximum 3 years, and that's still a very high ceiling to go from today's 70 million US dollar notionals. I think different commodities really have its different sort of learning curve about how to do risk management. In the traditional like crude and oil industry, it takes the miners a few decades, and they're still learning about the techniques, how to use the derivatives to help them to manage their risks along the in their production and in their trading activities. For Bitcoin, it's still very, very early stage. I think a lot of miners are figuring out that derivative is a very powerful tool for them to hedge off their risks, but they're still sort of learning, taking these learning curves and try to understand how it works. So that leads to my sharing today. Today, I really want to share about how to make, how does the risk management for miners work, and some of the most common and often used techniques in our view. Okay, the first one is really simple. It's called protective put. As one of the most typical needs of mankind is actually buying insurance, right? People pay a small premium and buy insurance to protect against bad things happening. It's same for miners, right? The bad things that for happening for miners is Bitcoin price really goes low. To be more precise, is the Bitcoin price goes lower than their cost of production. So it's simple. You can buy a protection, buy insurance of that. You can put the excess price as your cost of production. Let's say in this case, 5,000 all-in price, right, for mining of Bitcoin. And if the price does goes lower, and you will make a profit in this protective put, and that will help you to insulate from any further loss beyond that excess price. Another typical need of the miners is to generate additional cash flows to give some buffer to market fluctuations. A covered call will serve this purpose well. So a miner is naturally long in Bitcoin prices because he holds inventory, right? So by selling a covered call, it's covered because it has the miner has the underlying, which is Bitcoin, to deliver if the conversion happens. So he can sell a covered call at a price where he feels confident that this price is unlikely to reach at maturity, or he is comfortable that he does not mind to sell the Bitcoin at that price. So let's take this chart for example. He can set a price at let's say 10,500, right? And 10,150, right? And then if the price really hit that at maturity really hits that level, that he actually is taking profit at this level. But if it doesn't hit, he basically will earn an income, cash flow, which equals to the premium he gets. So he can constantly sell covered calls at the price that he feels comfortable over and over again to generate a sort of steady income from the cash flow of the premium. Another very typical or popular strategies is called principal protected products. So how does it work is that besides price protection, miners might also want to express their views when they have a very strong conviction of where and how much of the market is moving, right? Because you're in this industry, you really feel the dynamics of the market. Sometimes the miners do have a good gut feeling or the market feeling about where the market is going and whether it's going to be a big directional move. So why not make a good profit by placing the bet where your view is? That sounds good, great, right? But what if the conviction turns out to be wrong? and you're losing money, that could be hurting, right? So your business in mining, you don't really want to make a wrong bets, wrong speculation, and really losing money, and that in the end hurt your operation. So what you can do is that you can use some strategies that's principal protected. The ratio you see here is 100% and 99.5%. What that means? That means that 100% means that no matter what happens, you will not lose any of your principal. So it's 100% principal protection. And 99.5%, as the name suggests, is that if things go sour, and you will only lose 0.5% of the principal. So 99.5% of the principal is protected. Of course, you can see the number could be arbitrary, right? You can also take a high risk. You can say, I want to take a bigger bet, and I want to take a 99% principal protected, because I can't stand the risk if I lose 1% of my principal. That's fine to me. So it really depends on where your risk and return sort of appetite is, right? You can determine what are the right strategy, how much risk you want to take. So how does it work? Is that a typical contract we can write for you is that it's for the next 1 month, 2 months, or 3 months, like the near-term planners. If you have conviction that the market is really going to be bullish and really go up, and you can buy contract bets, you can invest like US dollar, USDT to buy this kind of contract, and it's spare cash for you, right? But you can, when your conviction is really honored, as the market really move as what you wish, you can really generate a return as a result, right? If the market really goes up, let's say take 11,000, for example, really goes up to 11,000 by end of this month or end of next month, you can get a return of like 15% for the 100% principal protected rule, or you can get around like 27, 28% in the 99.5% rule. As you can tell that a little bit, if you are willing to take a little bit more risk, you're actually getting a bigger return as a result. The same thing happens, just opposite to the bull. You can also enjoy a return from the bear if you think the market is going to go south and as you expected, and you can bet the market to go down and still make money. So it's indifferent like which direction you are betting, as long as you make sure that this is the direction you want to take. And then if that's turned out to be true, you are getting a good return on that. So you don't really have to, in this case, you don't really have to own the Bitcoin to enjoy the market's sort of in return as a result of Bitcoin price movement. You can invest in some spare money like US dollar or stable coins, and you can still participate in the Bitcoin price performance. And most of the time, other than very trendy market direction is really certain for the miners. A lot of markets, a lot of times the market can be lackluster and sort of directionless. There's only moderate range bounding for in the market, right? It's also quite common. And what you can do, you can still benefit from it and make an enhanced yield in a low volatility market like this. For example, let's say the spot market at the moment, the spot price of the spot price at the moment is 9,000 for Bitcoin. And if you foresee that the market is likely to be stagnant, the maximum fluctuation will not be higher than 10%, let's say. And then you can we can write this kind of structured product for you so that you will enjoy enhanced yield. You can see the pyramid, right? That's within, if the market moves within 10%. Of course, if the market moves outside this range, your return will be lower. But if it's within this range, you're actually getting pretty good double-digit returns, right? And other than the previous strategies, as I mentioned, another typical demand for the miners is loan, right? Because they tend to need to borrow for working capital financing. And a typical loan works like this, right? You have a platform like Matrixport or some other platform standing between of the borrowers and lenders. The lenders normally are like the funding partners where the money is coming from. The borrowers could be miners, could be retailers, could be funds who really need to borrow dollar or crypto assets, right? Normally in today's market, it works like as a collateralized loan, right? So if the miners want to borrow stable coins to fund their operation, he basically need to pledge the Bitcoin he has in hand as a collateral. And if market really moves, the collateral level will be changing, right? So you have to at a certain point of time, if market really goes, price really goes down, you have to make up the margin calls, pledge more collateral to put the collateral level to a safety level. So that's what happens. Especially the most recent memory is 12th of March. There's a really drastic drawdown in the market, and it's quite painful for a lot of the people who are borrowers, because you basically have to wake up in the middle of the night and answer those margin call and pledge more collaterals. Otherwise, you will risk losing your collateral Bitcoin at all all at once if the margin call is not answered. So this kind of scenarios is happening in crypto market because of the volatilities. So we are thinking of ways how we can make this better for most of the people, right? Talking of the benefits, what does zero cost loan means, right? So it means that when you pledge your Bitcoin, you want to get a loan, you can get a zero cost, and you can get a zero risk of liquidation. And at the maturity, if the price of Bitcoin is locked within the limited range of the range, you're actually mitigating the extreme price rise and fall. So the benefit of this apparently is zero cost, zero interest, and there's no margin call needed because there's zero liquidation risks. And also there is meltdown protection. Let's say if the price really of the Bitcoin really goes very, very low, it's a huge meltdown at maturity, and you don't need to repay the loan, right? Okay, so that's a good benefit. And also there's flexibilities. You can see how do you want to structure this loan, and there's also tailor-made. We can make a lot of tailor-made alterations for you. And speaking of all these benefits, what is the gist of this loan? Is that the idea is that by giving up the opportunity cost of some potential BTC upside and through the take profit point, you will be able to enjoy this benefit. So what you are giving up is price upside above certain price take profit level. But that take profit level should be a level you feel comfortable with if you're that's really happening. So take an example, right? What type of users should look at zero cost loan? The first is that if the person is sensitive to loan interest and expect the loan to be zero cost, you should look at it. And if you don't want to take the risk of potential collateral top up or forced liquidation, you should look at this. And if you want to focus on stable yielding and you don't mind to give up such an upside if it's above such a level, I think this is probably a product for you. And if you expect the Bitcoin price would not rise beyond the take profit price at maturity, that's pretty safe to take the loan, right? Because you lose nothing and you earn you actually getting zero interest. And if you want to mitigate the risks of drastic market decline or price meltdown, you should look at this. So let's put this into numbers, right? Let's say today's reference price, spot price is 10,000. I know it's not there yet, but let's just use it for example. And you are taking a loan at zero cost. You have the LTV, loan to value of 50%, which means that you pledge $100 worth of Bitcoin, you get $50 worth of loans. And you set the take profit price. This can be tailor-made at 18,000, let's say. is much higher than today's price, 80% higher. And you don't mind if it hits, you sell the Bitcoin at that price, and you have a protection price of 5,000, which is half of today's price, and you are borrowing for 4 months. So what's happening is that if the price at maturity is between 5,000 and 18,000, let's look at the purple like bubble. It's the middle part. If that happens, I think most of the time that's the case. You will repay the loan at maturity, and you will take back all your Bitcoin collaterals, and you are not paying anything. Okay, you are not paying any interest. And if it really goes above 18,000, let's say it's 20,000, what happens? It means that you can you will not recover your Bitcoin. Your Bitcoin is going to be sold at this level, 18,000, which means you are giving up like 2,000, which is the difference of the then market and this take profit price. You're basically giving up that 2,000 upside. But you get free, you get free loan, so you already invest that into your money operation, so that's not bad. If the market goes below 5,000, you don't need to repay the loan. So you just take the loan and then that's it. You don't need to repay it. So some of the tenors and take profit levels are available on our website and our app every day. So these numbers are refreshed every day. Sometimes it's more variety, sometimes it's smaller. But let's say if you feel that all these listed contracts or deals is not it's not what you want, you can also talk to us. We can also design a tailor-made solution for you to suit your specific cases. Yeah, so that's basically my sharing of today. In today's session, I shared some of the most common techniques and solutions that have been used by our users. And of course, there's more than that. If you have a specific need, feel free to talk to us and we can see what we can do for you. And our website is www.matrixport.com. And if you want to reach out to me, and I have my email and Telegram here. Yeah, I guess that's all from me, Shinju. Thank you.
Okay, fantastic. I think we have time for one more question. So there's 3 questions. Let's see. First one is, how can a miner hedge through the halving? Say Bitcoin price doesn't decrease, just block reward falls.
How? Sorry.
So the second question, you can actually read it.
Yeah.
So ask a question on the bottom, and I can type in the chat. This one.
I cannot see the question.
Can you see in the chat? I just typed it.
Oh, here I see it. Okay. So how can a miner hedge through halving? Say Bitcoin price doesn't decrease. Just block. You mean doesn't increase, right? Just a block reward for.
Yeah.
Yeah.
So not my question. Someone else typed it.
Okay.
Yeah.
Sure. So I think a lot of the miners are worried about that. Yeah. A lot of miners are worried about that. I think what they should pay attention to is how do they generate a steady returns out of their operations. I think it's a matter of fact that the reward is going to be halved. And I think most of the miners care to be stay in operation. So in this market, I would suggest that they either, if they believe that market is going down, they should really protect their positions by taking protected puts, or they could also sell like a covered cost to generate some sort of steady income to sort of dampen the effect of the Bitcoin halving. Yeah, and also relocate to the places where there's the cheap electricity cost, so that you can really enjoy a lower cost of production. That's also very important. That's why a lot of miners in China are moving to the southern west part of China to enjoy like a very, very low cost of hydraulic power, at least for the summer. So they help with sort of cushion the effect of the hardening.
Okay, fantastic. So if you guys have additional questions for Cynthia, please email her or hit her up on Telegram. And thank you so much for doing this talk. It was really informative.
Thank you.
All right, we're going to switch to the next session now. All right, thank you again.